Welcome back guys to another Zero DTE video, and today Ernie's going to be talking about trade execution, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's education platform. Enjoy guys.
There are a number of things that I have to know before I get into the trade. Number one, what's my position size? And I've gone through a lot of exercises and talk and in the trader's manual, how you figure that out. Essentially, it comes down to rule of thumb. If you have a bigger account, anywhere from $10,000 to $100,000 or even higher, it's approximately 1% of your account size. Do you trade your position size when you first get in? No, always trade lower. But the idea behind the position size is all based on math and statistics and potential streaks and all that. So that 1% is not just an arbitrary number that is chosen. It is chosen for a very specific purpose, for a very specific amount of drawdown that you can tolerate. Now, on the tolerance side of that drawdown, we say 10%, right? I choose something less than that. I choose 6% because 6% is better than 10%. Can't argue that. It is. It's better than 10%. Now, that doesn't mean that I let every trade go to 6%. It means that I'm trying like hell not to have any drawdown. And when I start approaching 6%, approaching it means I'm getting to 3, 4, 5%. I start invoking mitigation strategies. What that means is I start shrinking down to make it even more difficult for me to hit that 6%. And I do not let up until I've reached back into range that I can go back to my normal size and reach a new market high. So that's all involved in your position size. Next thing is I want to understand the market and the volatility so that I can know how big of a butterfly that I can put on. We're always putting on butterflies, right? We're always putting on out of the money butterflies because those work in our risk to reward asymmetry philosophy, right? And we always want to make sure that our risk is at most 10% of the width, at most. In other words, it shouldn't go over 10%, but it can very naturally go under 10% if you want. No problem. We know that there's a range from 10% down, maybe as low as 5% of the width of your fly that will work and work well. We just don't know where the sweet spot is. We also don't know where the sweet spot is in terms of the total width of your fly, but we do know that in low volatility situations, the total width of your fly should on average be much narrower than it is when there's high volatility. And high volatility, we widen, we become more expansive. In low volatility, we contract. We know these things. These are our standards. Right now, the VIX is super low, so we choose a range that is very low. So if I were to use the E-mini or the SPX as an example, 10 to 20 is a narrow range. It's small and narrow, and that's a good range, 10, 15, 20. Which one you choose on any given day doesn't matter. Really doesn't matter. It may matter a little bit in terms of your own personal risk management. Maybe the 20 wide is too rich for you for whatever reason, or I don't know, but it shouldn't. I mean, it should work for most people. But you choose something 10 to 20 wide. I think I chose 15 this time. The other day I chose 20. The day before that I chose 10. Why did I choose it? Because I had any great insight, because it was just different. I just bounce around. And the reason why I do that is that I'm trying to get data on all of these. I know that I don't have the insight or the technical chops or some technical magic that's going to tell me what is the optimal size. Nobody does, as much as you may think you do with your gamma and spot gamma and other theses that you come up with. You don't. You don't know. What I do know is that by exercising that range and then reviewing it over time and gathering up enough data so that you have enough data points across that range, you can start seeing what's working and what isn't, what works better than the other. And then that might encourage you to favor one side or the other. Go with what's working. But you won't know by choosing things that are outside of this that you know nothing about unless you do the work, right? If you're doing the work, if you're testing it, you shouldn't be testing it with real money. You should be putting it through the rigors of some sort of scientific process, like I outline in my strategy life cycle, which you can find down in the strategy curation channel. And so if you want to explore those strategies, that's fine, but practice this one, the one that works, right? Get good at that. And you can do the other stuff on the side. And if you find that's better, then by all means, share with us why it's better and start trading that. But in the meantime, I've got something that I know works. So use it, get good at it, put on the right position size. So I put on a 20 wide. I make sure that my debit is less than 10%. I should say I put on 10 to 20 wide, but today I put on I'll just say 10 10 to 20. And then I execute it. That's it. What time do I put it on? Oh, time. You can put it on the day before. You can put it on before the market opens. You can put it on right after the market opens, but put it on before the afternoon. It's both direction and premium eroding. One is that our strategies are both directional strategies and taking advantage of the zero DTE event, that premium eroding. The vast majority of the premium is going to be eroding, and the volatility is going to be affecting that premium in the early part of the day, mostly the morning session and a portion of the afternoon session, first part of it. After that, volatility is not expanding or contracting premium to any great degree. Time is taking over. So that's the point that we want to be in. We want to try to get on the leading edge of that volatility dropping if we can. It's not always possible. We don't always know when's the best time, but that's ultimately what we're trying to do, because at some point in the day, that volatility does fall off and then the premium decay accelerates. Now, in low volatility times, there's less of it to do because that premium decay is already pre-accelerated. In high volatility times, there's a lot more of it for us to do because it is inflated and there's more of it for us to work with in the morning. And so there's a better chance of us getting it falling off of a cliff, right? That goes to also why we go with wider or narrower flies, because of that volatility issue. But that timing of getting it in the morning is when you're going to feel that issue the most. After you get into the afternoon, that whole dynamic goes away. And also in the morning, there's a greater chance of you capturing the bigger move, because a lot of times that's what happens in the morning. It tends to move the most, or sometime from there until noon. Now, of course, some days it meanders along and then just drops sharply or goes up sharply too. But that's the minority of cases. Sometimes it goes right out of like a bat out of hell, straight up, and then reverses a certain amount and then rejoins and keeps on going. Other times it reverses and keeps on going down. Other times it reverses and reverses and then reverses and reverses again. All of those things happen, but the vast majority of the time, the bigger move is happening earlier in the day. So for all those reasons are why we put the trade on before the afternoon. Number 4 is the profit framework. That's where we make hold or fold choices along the way. So we have zone 1, zone 2, zone 3, morning, afternoon, closing. And our goal is to continually update each one of these intersecting times and places as we learn. I give you starting points, but the starting points are relatively aggressive. But that's on purpose to try to get you to just take profit a little bit faster. But our goal is to, over time, start becoming quite adept and knowledgeable and nuanced about how we act in each one of these situations. And that's going to continue over and over again over a long period of time. And it's going to change. So after a while, you start realizing that your framework in low volatility regimes is going to be very different than in high volatility regimes, or different from the Goldilocks zone. So the whole thing is relatively simple, but filled with immense amount of complexity and philosophy and math and real world truths and behavior of the market. And what we try to do is play the probabilities on what those things that occur will give us the best opportunity to profit. And overriding all of that, we employ a certain set of tenets. There's that asymmetry. There's the tenet that we focus more on preserving our capital through asymmetry rather than going after profits. We are far more focused on developing our process over trying to invoke an outcome. And through all of that, get that kind of mental toughness and consistency through the development of a continuous improvement process.
Thanks for watching, guys. I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks, guys.